Welcome back. Do you still remember what ways there are to raise capital? That's right. The two most common approaches include debt and equity products. Before anything else, please bear in mind that a bond has the following basic structure: principal amount, known as the face value or par value, and a predetermined interest, referred to as the coupon payment. In its core, a debt security is just like a loan. Simple as that. Investors love this instrument because it gives them a fixed income stream, the coupon payments on pre-scheduled dates, and a full principal repayment at the maturity date. That sounds like a low-risk investment for practitioners, doesn't it? Okay, so much for debt securities. In this video, we will delve into the types of equity securities instead. In essence, they represent the shareholder's stake in a company in the form of common and preferred stocks. Have you ever dealt with any of these? Well done! What we know about common shareholders is that they get the remainder of what's left after all the assets liquidate and the company's debt is paid off. Here, we come across limitations where firms have no obligation to pay back shareholders, and common shareholders receive dividends only after preferred stockholders obtain theirs and debt holders receive their interest. Knowing these, common shares can be divided into callable and puttable. The former gives the company the right to buy them back at a predetermined call price. From a strategical standpoint, this feature is valuable to the issuer because it calls back the stocks whenever the market price is higher than the call. Obviously, these securities allow for a firm to retain tighter control over its business. With puttable common stock, on the other hand, investors have the option of selling their shares back to the issuer at a specified price. The put option has been designed to help shareholders by acting as an insurance in the event the price falls significantly. This makes such stocks attractive to investors. No wonder they cost more. On a separate note, if you were, let's say, a common shareholder, would you have a role in a firm's decision-making? Yes, you would. Common shareholders reserve the right to vote on corporate issues, such as mergers and acquisitions and the election of the board of directors. When a common representative is unable to partake in a conference, they send a knowledgeable replacement instead, typically an investment advisor. We call this proxy voting. What about voting mechanisms? Well, we may come across either statutory, also called straight, or cumulative voting. In the former, each share counts for one vote, and votes must be divided evenly among the candidates or issues discussed. Let's see how the math works out. If you own 100 shares and vote on a new board of directors with 3 positions available, you could cast 100 votes for each board member for a total of 300 votes. But you cannot place 10 votes for each of the 2 board members and 280 for the third. Okay. On other occasions, we encounter a cumulative voting structure. It allows shareholders to direct their total voting rights to specific candidates. Instead of doing it for each individual board member, they can decide to accumulate their positions and cast them for a single representative only. So, you can place all 300 shares on one executive. This way, minority shareholders get a higher chance of electing their director of choice. Consequently, they will have a bigger representation on the board than they would have otherwise in a straight voting system. Excellent! Now, we shall check out the specifics of preference shares. Preferred stock is a hybrid financing instrument because it has features of both common stock and debt. Like common equity, it does not have a maturity date. Nevertheless, it grants a fixed-size dividend resembling a fixed coupon rate bond. This is how Warren Buffett made a fortune during some of the darkest hours of the financial crisis in 2008. By investing $5 billion in preferred stocks of Goldman Sachs, he made about $1.75 billion, realizing a 35% rate of return. Not bad for a single bet, right? In a sense, preferred means that firms offer such investors additional insurance. If the company becomes financially insolvent, preferred stockholders claim on assets before common shareholders do. They also offer more predictable cash inflows. Compared to common shares, their fixed dividends are generally higher. That's why it's only natural for corporations to hold an affinity for them. Same as any investment vehicle, preferred shares have their drawbacks as well. One downside is that they do not offer any voting rights, giving their holders no control over the firm's management. In terms of structure, preference stock can be cumulative or non-cumulative. The former specifies that any missed and unpaid dividends must be made up before common shareholders receive theirs. By contrast, non-cumulative preference shares lack such a provision. If the company doesn't pay dividends in a given year, investors forfeit the right to claim any of the unpaid amounts in the future. Besides, preference stocks can be divided into participating and non-participating. we better take a closer look at how these two work. Okay. Overall, preferred stock normally carries a par value and a stated dividend rate based on that par value. For example, Company Alpha, which issues a $100 par issue with a 5% dividend, pays a dividend of $5 per year. Participating preference shareholders have the right to receive the standard preferred dividend plus an additional one, based on pre-agreed terms and conditions. To a certain extent, they have upside protection and will collect an additional dividend anytime common stockholders do. For the most part, the bonus payment equals the difference between the two dividends. For example, if common shareholders receive a dividend of $2 per share, whereas preferred stockholders only 0.5, the latter are entitled for an extra $1.50. On the non-participating preference front, shareholders get only a fixed dividend payment. Put simply, they don't share in a firm's profits. Back to the same example, we already know that each preferred share is entitled to receive $5 in dividends. Now, imagine the firm has better than expected financial results and decides to pay $6 in dividends to common shareholders. A participating preferred stock would participate with the common stock to secure an additional $1 per share, $6 minus $5. On the contrary, a non-participating preferred stock would receive a dividend of $5 per year only. Excellent! Before we wrap up, we will outline the last criterion that differentiates preferred shares. It has to do with the option of stock convertibility. Thus, we distinguish between convertible and non-convertible options. The former can be converted into common stock at a fixed conversion ratio, determined at issuance. For instance, at a fixed conversion ratio of 0, you can trade in 1 preferred share for 6 common shares at your discretion. Convertibles are popular for those who want to participate in the stock market without taking wild risks. That's why these securities are often used to finance risky venture capital and private equity firms. Value-wise, whenever common shares outperform convertible, preferred stockholders should go ahead and convert. Why? Because under these circumstances, common stock will earn higher profits.